Long before the New York Stock Exchange introduced securities trading in 1792, the Italian city-states led by Venice pioneered the exchange of securities in the 13th century. Today, the world's largest stock exchanges can be found around the globe, from New York to Bombay. New York Stock Exchange is considered the largest by value and volume, followed by Nasdaq, Tokyo, and the London Stock Exchange. So why do companies list their shares on stock exchanges? In attempts to grow and transform their businesses further, private companies will look to raise capital by offering their shares to the public. By doing so, the owners of the company will give up some of their ownership in exchange for the capital they need to expand. The process of listing shares is known as underwriting, and large investment banks such as Credit Suisse and Goldman Sachs typically administer it. After shares of a company are issued at the primary market or at the initial public offering, IPO, they start to trade on an exchange. The pool of shares available to buy and sell at the open market is then known as the float. So let's look a little further into stocks. A stock is a share of ownership in a company. By purchasing a stock, you become a shareholder in that company. You may benefit from dividends, can vote on key corporate decisions, and possess certain rights. To buy 100 stocks in company ABC at $10, you need $1,000. Purchase equals ownership. The price of a stock goes up and down depending on many factors. You purchase the stock at a quoted price, and the rise or decline in the stock's value results in either a profit or a loss. It's considered a traditional way to trade financial markets. And trading stocks means you have to purchase them before you can sell, meaning that you can profit from a rising price only after you've bought the stock. If the stock drops below your purchase price, you lose out. You want to invest in company ABC, and it's trading at $10 a share. You believe that the stock is going to rise, and therefore you want to invest. You want to purchase 1,000 shares. With a traditional stock purchase, this would cost you $10,000, or 10 times 1,000, plus any associated costs. So you buy the stock and it goes up to $11 per share. You decide to sell the stock and therefore get $11,000 back. This would net you a $1,000 profit, ignoring trading costs for the sake of this illustration. Your $1,000 profit on an initial outlay of $10,000 means a 10% profit. When you buy shares of a company, you become an owner in the company, and therefore you're entitled to the earnings generated from the company's business. You become a shareholder. Stocks are also referred to as equities or securities. The total number of shares issued by a company is defined as shares outstanding. Authorised shares describe the total number of shares a company is authorised to issue. This takes place when the business is first incorporated. For instance, if a company's articles of incorporation show that XYZ has authorised 1 million shares, then only 1 million shares can be issued and no more. From the authorised shares, company XYZ may offer 300,000 shares through an IPO to the public. The company, in the form of treasury stock, retains the remaining shares of 700,000. At a later stage, the company may offer more shares or decrease the number of shares in the market in the form of buyback. Buyback can occur when companies have extra cash on hand and are looking to retire or cut down the supply of stocks in the marketplace. By cutting the supply, the value of the shares may increase further. The term market capitalization refers to the market value of a business measured by its price per share, multiplied by the shares outstanding. With capitalization of $394 billion, Microsoft will be referred to as a large capitalization company, or just large cap. By definition, if a company has a market value above $10 billion, it's considered large cap. If it's between $2 billion and $10 billion, that capitalization is considered mid cap, and below $2 billion, it's small cap. There's a fine line between what constitutes investing and speculating, but it's important for stock investors to come to grips with the two, as it may help them define their approach to the stock market. Investment may take many forms. You may invest in land, in a commodity like gold, or in a company, as in the case of stocks. You may hold on to that investment for anything from a few months to many years. As a speculator, however, you may not take time to know the business that intimately. You would look to benefit from the fluctuations of the stock prices and buy shares in order to sell them at a higher price to someone else. As a time horizon, you may hold these shares from just a few days to a few weeks. Risk. In finance, the possibility of losing some or all of your investment is referred to as risk. The more risk you take in the market, the bigger the potential for loss or gain. Sometimes risk is referred to as volatility, or how much an investment can fluctuate up or down. It's imperative for novice and experienced investors alike to understand the implied risks of a stock investment. A publicly traded company will offer two kinds of stocks, common and preferred. A common stock is typically what most businesses will issue. As mentioned in Section 1, common stock represents an equity ownership in a company. Owners of common shares may or may not receive dividends from holding the equity. Preferred shares will almost always distribute dividends to shareholders. Due to its preferred status, the payment of dividends will occur before any payments made to common stockholders. Size. In Section 1, we mentioned that according to their market capitalization, stocks are divided into three different categories: large cap, mid cap and small cap. Large capitalization companies such as Daimler AG or General Electric are more established and tend to have more stable earnings. Stable earnings can often translate to stability in the share price. On the contrary, small capitalization companies tend to have unstable earnings and share prices. Investors could find a compromise with mid-cap stocks, which offer growth and stability of a larger company. Stocks are defined as domestic or foreign, simply based on your location. If you're based in the UK, then stocks in the FTSE 100 would be considered domestic. One of the main benefits to investing in foreign stocks is diversification. Most investors have near-sight vision when it comes to investing, and they invest in what they know best, their own market. This bias towards domestic companies does have its benefits, but it also has its risks. For instance, if you invested your entire portfolio in Greek stocks over the last decade, you probably got crushed by the economic meltdown in that country. Foreign stocks, particularly in emerging markets, as these economies are in the middle of rapid economic growth, could also reward investors looking for higher growth. Between 2010 and the end of 2014, shares of American tech giant Google returned an outstanding 103%, while shares of its Chinese counterpart, Baidu, have gained a formidable 460%. One must mention here that potentially higher returns could of course lead to higher investment risks. One of the biggest disadvantages of investing in foreign stocks could be the risk of foreign exchange. Foreign companies trade and pay dividends in their own currencies, so if you're based in Germany and get a dividend from a US company, it would be in dollars and therefore needs exchanging into euros. Last but not least, smaller markets around the world trade significantly less volume than some of the bigger exchanges. Now, this may lead to lack of liquidity, where investors might be at risk of not being able to easily sell their stock holdings. So let's summarise what you've learned. Exchanges around the world have become an important mechanism for companies to raise capital by issuing shares. Shares worth trillions of dollars are bought and sold every day on the secondary markets through exchanges like the LSE, NYSE and the Nasdaq. Now, whether you're looking to invest in the stock market for the long term or you're looking to speculate on the next Apple shares, you must take time to learn and understand the risk involved in the market and manage it. Only by minimising the risk and the potential losses will you be able to hold on to your gains and move forward. Corporations will generally issue common and preferred shares. Preferred shares have advantage over common shares as their shareholders will receive any paid out dividends before the common shareholders. Investors looking for a long-term return could consider stocks that pay out dividends and also provide growth. The market capitalisation of a company is determined by the number of shares outstanding, multiplied by its price per share. Large caps are stocks of companies in mature stage with stable or limited growth potential. These companies tend to grow from acquisitions of other companies. Investing in foreign stocks can potentially require a higher tolerance for risk, but could reward investors by providing diversification away from domestic assets.